This is Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. Here's your host, Doug Hoyes.
It's the end of the month, so it's time for a frequently asked questions episode here on Debt Free in 30. And today, all of our questions are going to focus on one of the most common reasons for financial problems, relationship breakups. When you look at the numbers, more than one quarter, about 28% of our clients, were separated or divorced at the time they filed a bankruptcy or a consumer proposal. And 19% of our clients said that marital or relationship breakdown was the main cause of their financial difficulties. So why is that? What are the issues and what can you do to solve those things? To find out, I've asked Ted Michalos to join me once again. So Ted, let's start with the first question. Why is it that people who go through a relationship breakup end up having more financial problems than if they were still together? What are some of the common reasons?
Well, you know what the question we probably have to answer first is, did the money or financial problems cause the breakup, or did the breakup cause the financial problems? Because what happens when your relationship starts to deteriorate is you don't pay attention to some of the basic things. And that usually means money. So you order out more, you're buying things either for yourself or your family members as a way of, instant gratification. You're buying love. And while you're not paying attention to all these details, your debts start to spiral out of control. Then when the relationship actually breaks down, well, somebody's still got to pay for all these bills. So it can be a hell of a mess.
So it's a chicken and an egg thing then. What's the answer to the question then? Do the financial problems cause the relationship breakdown, or does the relationship breakdown lead to financial problems?
And in my experience, it happens both ways. So there are relationships that were in fine shape until money got tight. And then the money adds a pressure to the relationship that the couple just can't deal with. There are relationships that were never going to work. And quite frankly, it doesn't matter how much money they threw at the problem, they just never were going to work.
So it can happen both ways.
That's right.
So you're together and things are financially humming along. There's some perhaps external shock, somebody loses a job, something like that. And then maybe not as a result, but inevitably you end up getting separated. Why does that cause an extra financial burden then?
Well, let's think about the basics. When you're living together, you've got either one mortgage or one rent to pay every month. And now you're separated and there are two. Let's think about the things in your household. So you've got one household, you got one toaster, you got one microwave oven, you got one set of monthly bills. Again, now that you're separated, you've got to have two. And all of that creates all sorts of pressure. There are, accountants call it economies of scale. There are some things that are less expensive the more people that are involved in a household. You lose all of those when you start running multiple households.
So it's the old saying, two can live as cheaply as one.
Correct.
It's not entirely true, but if
not with my wife.
If we live in a one-bedroom apartment and we get separated and we both end up getting a one-bedroom apartment, well, obviously our living costs have doubled for that.
That is the single biggest hit. The living costs suddenly double because you're not sharing anything.
You've each got your own phone now, your own cable, your own hydro, your own
groceries, again, the toaster is a silly example, but you both need a toaster.
Yeah, I guess with groceries, the costs probably come down if there's fewer people, but a lot of the other things are fixed costs. That's just the way it is. Now we need to have two cars. We can't share one, that sort of thing.
Well, and the groceries don't necessarily come down either because you're not buying the right type of food, and you both got to have that bottle of ketchup in the fridge. It may take you a little longer to go through it, but you're still spending that money, at least up front, to establish your new household.
So it ends up causing financial problems. And as I said at the opening, almost 20% of our clients who ended up filing a bankruptcy or proposal said that it was that separation or that divorce that directly attributed to their financial problems.
And we're not even touching on debt issues now. So let's say the couple had, a couple of credit cards and a line of credit. Well, again, what I was saying earlier, as the relationship starts to deteriorate, people tend to order out more. They buy more things either to make themselves or family members feel better. They're not paying attention to the debt. But once that relationship is broken down, the debt is still there and somebody's got to deal with it.
And if you are needing to buy that second toaster, that may be the time you end up going into debt. Again, we're using a silly example.
Do they still sell toasters?
I don't know.
I assume they do.
I'm sure they're fancier than they used to be. But
sure.
But I mean, whatever you need, furniture for your new place, whatever, you end up using debt to purchase that, and all of a sudden, boom, you've got more debt than you started out with. So let's take the story to its logical conclusion then. Let's say that due to the separation or the divorce, I've now got a whole bunch more debt than I used to have, and I end up saying, you know what, I've got no choice here. I've got to file a proposal or a bankruptcy. How is that going to affect my life? So let's take the first issue, alimony and child support. How is that dealt with in a bankruptcy or a proposal?
So the first thing everyone needs to understand is that support payments are generally set by a court order or by a divorce or separation agreement that you've signed off on. In Ontario, there are government published grids or scales showing you how much support you should be paying for children and guidelines for what you should be paying in the form of spousal. So if a court orders a support payment of some description, then the only way that payment can be changed or reduced is by the same court. So bankruptcy is designed to deal with your unsecured debts, credit cards, lines of credits, payday loans. Let's not talk about them today.
No, we've done enough shows on those.
And things like that. It cannot deal with support. More importantly, it cannot deal with support arrears. So if you've agreed to or been ordered to pay support, it's something you're going to continue to pay until a new agreement or court order is in place.
So let's look at that, what you just said, from the point of view of the person paying the support and the point of view of the person getting the support. So if I'm the person paying the support and I've got a bunch of support arrears, so we got separated, I wasn't able to keep up with my support, so I've now got a bunch of other debt as well. If all I have is child support owing, does it make sense to go bankrupt?
No, it doesn't make any sense at all. It won't protect you. Your best line of defense, if your problem is just child support arrears, is to negotiate either with your estranged spouse, and probably won't be able to do that if you're deeply in arrears, or contact the Family Responsibility Office and say, this is what I can afford to pay. Under Ontario law, the maximum amount that you can be garnished for any sort of support payment or judgment is 50% of your pay. So if you're already at the 50% maximum, that's as far as they're going to go anyway.
So let's assume then that I got separated. I got a bit behind on my support arrears, but I've also got a bunch of other debt as well. I had to,
which is almost always the case.
That's the situation. I got a whole bunch of other debt as well. So does it make sense potentially to consider a consumer proposal or a bankruptcy in that case?
It certainly can. I mean, if the issue is you've only got so much money coming in every month, and now a portion of it is being paid to support for your children or for your ex-spouse, that's just the way that it works. You're left with X amount of dollars. You've got to pay your basic living expenses. Whatever's left is going to be dealt with. You're going to throw it at your debts. So if you have enough that you can offer to repay a portion of your debts, then a consumer proposal is a great plan. And what it does is it stops the interest and it gives you one monthly payment to worry about. They can't take legal action against you. You don't have to worry about another wage garnishee. If you have very little money left over, then perhaps the bankruptcy makes sense because it draws a line in the sand and it eliminates the debt. So again, you're trying to get a problem off your plate. Can't do anything about the support. You're going to deal with that as long as the children are underaged or in school. The spousal support will last as long as you were ordered to, but we can help you deal with all of these other things. And frankly, they're the ones that cause you the most grief.
So that's really the key point, that your support isn't going away, whether you're bankrupt or not. But if you do a proposal or a bankruptcy, you can ease the pressure from all the other debts, which gives you the money to pay your support.
That's right.
It's pretty much as simple as that. Mm-hmm. So you talked about whether I have a lot of money or not a lot of money. So let's take the example of a single guy who has, I don't know, he makes, $3,000 a month and he's ordered to pay, $1,000 a month in child support. What does a bankruptcy look like for him?
Well, so the government has established guidelines or standards for how much money they think an individual needs to live on. Single guy, it's about $2,100 a month. So that's after tax, after support, after all deductions. So if this fellow was making $3,000 and paying $1,000 in support, he's left with $2,000 a month to live on. The government would say, if he were to file bankruptcy, it'll just be the cost of the bankruptcy, usually somewhere around $1,800, $2,000.
So he doesn't have to pay anything extra. So support payments that I'm making are used to reduce my income, which in some cases will put me below this government threshold.
And the flip side, of course, is those support payments are counted as income for the person that's receiving them. So, I don't know, let's say I was paying support to an ex-wife. So it comes off of my income when we're calculating what a bankruptcy would cost me, but it would be added to her income when we're figuring out what a bankruptcy would cost her. And that does make sense.
So I guess that's the answer to the second part of the question then. How does a bankruptcy impact on the person who is receiving the support, which more commonly is the wife, but obviously doesn't have to be?
Yep.
So in that particular case, the recipient's income is increased by the amount of support they're receiving.
That's right.
So using an example, so let's take a person who has one dependent. Okay. So, and we're recording this in 2016. The numbers we're quoting change slightly each year. So if you're listening to this podcast 5 years in the future, the numbers might be slightly different. But for a family of two, so a single parent with one dependent, they're allowed to earn roughly how much?
$2,600 a month.
About $2,600 a month. So if I have a job and I'm making $2,500 a month, I'm under the limit. But if I'm the person on the other side of this transaction getting the $1,000 in support, that would put me over the limit.
That's right. And another complication, things like baby bonus and the universal child benefit that's out now, those are treated as income as well. It's unusual for the spouse receiving support to end up being penalized in this way because usually their income is significantly lower. That's one of the ways the systems work, but it's certainly possible. The magic number, again, for that family of two is around $2,600. So if someone was making $800 a month part-time, they're receiving $700 a month in baby bonus and other government benefits and $1,000 in support. That's $2,500 a month. They're still under the guidelines, so they'd be okay. But obviously, if they tried to work any overtime or get a second job, it could put them in jeopardy.
And when you're doing that math, you would deduct childcare costs from that.
That's exactly right. So that's another complicating factor. If in order to work, you've got, or for whatever reason, you've got to pay childcare costs, the government considers that a deduction from your expenses before they charge what a bankruptcy will cost you too.
So I guess the summary point here is if you are considering a bankruptcy, you want to crunch the numbers first. If you are paying support, that potentially lowers what you'd have to pay in a bankruptcy. If you're receiving support, that potentially increases what you'd have to pay in a bankruptcy. But the math has to be done. There's so many moving parts here, as you've described.
It's going to sound self-serving, but frankly, the best advice I can give you is to contact a licensed insolvency trustee to ask them to walk you through the numbers. There's no charge for that first meeting. And these government payment calculations can be tricky. I mean, they confuse people in the industry, so a layperson could really get blindsided by them.
But it's a calculation that
math.
We can do it in a minute. It's, we've got the wherewithal to do that very quickly. So rather than trying to follow all the numbers we're throwing around here, I agree, talk to a licensed insolvency trustee and we can walk you through it. So we talked about the whole income end of things. So what happens if we go bankrupt and we own assets together?
Yeah, it starts to get a little more confusing. So the way family law works, at least in Ontario and most provinces in Canada, there's an equalization of the assets. So for instance, they make in a divorce or separation, you make a list of the things that you own yourself and that your spouse owns themselves. And then there's a list of things that you own together. Most often that's the matrimonial home or a cottage. And then some sort of assets will be transferred or money will be paid to make those numbers equal.
Well, so let's take an example then. We own a house together.
Yep.
And the house is worth, $400,000 and the mortgage on it is $300,000. So just for the sake of total simplicity here, let's assume then that the equity in the house is $100,000.
Yep.
And if one of the spouses is going bankrupt, how does that affect them?
Well, and so the plan through a separation or divorce would be that $100,000 would be divided by two. Each spouse is entitled to 50% if they own the house joint and severally, or if they were married. Interestingly, it's an aside, sorry, in common law relationships, you don't equalize the assets. That's something to talk about in another show. So $50,000 is going to either spouse. If one of the spouses files bankruptcy before the house has been dealt with, then that $50,000 worth of equity becomes an asset in the estate. So the person's trustee is going to have to deal with that $50,000 for the benefit of their creditors. It complicates things greatly.
So if my spouse goes bankrupt and we both own the house together, I guess it doesn't matter whether we're separated or not. We both own a house together. Right.
Your equity is worth $50,000. We got to deal with it.
Yeah. So the spouse who goes bankrupt either has to give half a house to the trustee or has to give $50,000 in this particular case. So now, what about the scenario where we get separated and one of the spouses says, "Hey, I'm giving the house to you. You've got the kids. You get the house. As part of the separation agreement, I'm going to sign off. You get the house." And then subsequently, that spouse goes bankrupt. How does it work then?
That's actually fairly common. If it's a bona fide transaction, so the spouse gifting the house to the other spouse has done it for legitimate reasons, then the court generally won't do anything about it. So, for example, instead of the husband paying spousal support for the next 5 years, he's given the house to his ex-wife. Well, the court would view that as saying, okay, he's gotten himself out of the obligation of spousal support so that he now has more money to pay his own obligations, and in exchange for that, he's given her the house. That would probably be viewed as a legitimate transaction. There are cases where people do this as a bit of a scam. So they pretend they're being separated or divorced. They transfer the house. One of them files bankrupt, and yet, 3 weeks later, they're back living together. And they say, well, we've reconciled. If it's not a real transaction, there is a risk that you can get into trouble with it.
And I think
that's not for most people.
Again, the point here then is there's a lot of complications to this. It's not simple and straightforward. And our advice whenever you're going through a separation would be to speak to a lawyer. We're not lawyers. We're not trying to give legal advice here. We're not trying to explain all the intricacies of how assets are split up and all the rest of it. It's something you want to consider going into it so that you know what the potential ramifications are.
Well, and we take that a step further. If when you sit down with one of our trustees, you tell us that you're going through a separation or divorce, you're going to be asked specifically, is your lawyer aware that you are here talking to me today? Because there are things that need to be done in a certain sequence to optimize the situation. I mean, it's a bad situation, but you want to make the best of it.
Yeah, and you gave the obvious example. If the separation agreement is done and the house is transferred before one of the parties goes bankrupt, well, then the other party, generally speaking, gets to keep the house. And that's probably the correct result. I want my kids to have the house they grew up in to be able to live in. Yep. And so by organizing things in a logical manner, you can save a lot of problems.
No matter how mad you are at them, take the time to talk to your lawyer, take your time to talk to a trustee, and do it in the right sequence.
Because it will end up helping you. So final issue then to discuss is debt. So we talked about assets. What happens if we have joint debt together?
Well, here's the typical scenario. One of the spouses, generally the man, will say, I'll take the debt on. And they, as part of the separation or divorce agreement, agree to pay it off. The problem with that scenario is, of course, that the lender isn't party to the agreement. So the lender, one of the big banks, approved the two of you for this joint debt, line of credit, loan, credit card, whatever it is. And just because one of you says, I'm going to pay it off, it doesn't mean that the lender has said, well, we're going to let the other one off the hook. And that's the trap that most people fall into. So Bob takes on all the debt so that Carol can get on with her life. Bob defaults on it and files bankruptcy or a proposal, and the bank goes after Carol for the debt that she was co-signed or joint on.
And Carol's saying, wait a minute, that's not fair. Bob said he was going to take it. We got a separation agreement. He said he was going to take it. Come on, bank, you can't come after me now for it.
Doesn't matter because the bank wasn't party to your separation agreement. The bank approved the two of you to borrow the money, and the bank expects both of you to pay it back.
And that's the key. You're married to each other. You're not married to the bank. You got divorced from each other. Well, you didn't get divorced from the bank. So is it as simple as just saying, okay, we're going to get divorced. I'm going to take on all the debt. So let's go to the bank now and just take your name off it.
If both of your credit histories and records are good, you might be able to do that. And we certainly suggest that people try. But in most cases, the banks had two people sign that loan or credit card agreement for a reason. They wanted both of you on the hook. So unless you are in really strong financial shape, they're not likely to let one of the people off. What you end up doing is negotiating new loans, new lines of credit, new credit cards, and transferring balances. So Again, we'll go back to Bob and Carol. They've got a joint line of credit. Well, Bob applies for a new line of credit and uses it to pay off the old one. And then Carol's not involved with his new debt at all. That's really the only way to protect Carol.
And of course, it's not as simple as that for Bob, because then if he goes bankrupt the next day, the bank's going to say, wait a minute, you just got this brand new line of credit yesterday.
Right.
What were you doing? So again, there's a lot of moving pieces here, and there are things you can do to protect your family, but you got to do the thinking up front. And again, talking to an appropriate lawyer, a licensed insolvency trustee to figure it out is the way to do it. One final question. Is it ever possible for the two spouses who are now separated, but they've got all their debt together, to file a joint proposal to deal with it all in one fell swoop?
Certainly, and quite frankly, that's usually the least expensive way to deal with it. If they file proposals separately, the debts end up being counted twice, and they end up paying more back in total between the two proposals than they would in just one. Here's the catch, though. They've got to be cooperating enough with each other that somebody's going to make the payments every month. So if you agree that you're each going to make half the payment and one of you gets mad at the other and stops paying, you're both in trouble.
Yeah, because in a lot of proposals, the bank is going to say, yeah, we want to be getting 30 cents on the dollar. So if you each file a proposal separately, well, they may want 30 cents from each of you. If you file a joint proposal, well, it's 30 cents in total. But you're right. If it's going to be a 5-year proposal and you're now separated and getting on with your life, who's making the payments? Well, it's financially the best option, but it may not practically be the best option.
Right.
Excellent. Well, thanks very much, Ted. I think we covered a lot of ground there. We're going to take a quick break and be back in a moment. You're listening to Debt Free in 30.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. It's time for the 30-second recap of what we discussed today. On today's show, Ted Michalos and I discussed how divorce can lead to financial problems, and we discussed strategies to deal with debt after divorce. That's the 30-second recap of what we discussed today. As I said at the start of the show, about 1 in 5 of our clients said that marital problems were the main cause of their financial difficulties. So if you're going through a relationship separation, you're not alone. Your number one goal is to protect yourself. So protect yourself by opening a new bank account in your name only, and separate yourself from any joint debts so that your ex is not able to increase your debt without your knowledge. Professional advice is important, so get the advice of a good family law lawyer, and if you have more debt than you can handle, talk to a licensed insolvency trustee. That's our show for today. To find out more about dealing with divorce and debt, please visit hoyes.com, that's HOYES.com, for full show notes and resources to get a fresh start. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.
Thanks for listening. That was Debt Free in 30.